This is how infinite banking builds wealth and reduces taxes. Now, on the outset, it may sound that building wealth and reducing taxes are mutually exclusive. I mean, after all, it's common knowledge that the more wealth you create, the more tax you pay. And that is the general rule. It's also well known that the very wealthy are able to create tax deductions, write-offs, and shelters that shield them from having to pay tax on a portion of their incomes. Well, the infinite banking tax-free cash growth warehouse strategy does the same for those with average incomes, as well as for those with high incomes. Part of the explanation will be a review for you who already know what infinite banking is and how it works. I will also be revealing and explaining specific strategies using the infinite banking tax-free cash growth warehouse method that make it particularly effective for building wealth and reducing taxes. Aloha, I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy, and I'm the managing director of the Hawaii Financial Freethinkers Academy, a nonprofit financial literacy education organization. For the past several years, I have focused on and specialized in the infinite banking concept and developing the tax-free cash growth warehouse finance strategy. If you find this to be helpful, please like this video and subscribe to this channel. Also, please post your questions and comments here. There are specific tax laws that give the cash value of whole life insurance the greatest advantage in the IRS tax code. And there are specific rules built into the policies of many life insurance companies that give unique advantages to the cash value of whole life insurance. It is for those reasons that the infinite banking concept was built on the use of the cash value of whole life insurance. Specifically, regarding the tax laws, the cash value of whole life insurance is allowed to grow by means of the guaranteed compounding interest and dividends tax-free. Also, the financial rule of first in, first out applies to the cash value of whole life insurance. Now, what that means is that the premiums that you pay into your whole life insurance, which is the first money in, will be the first money paid out should you decide to take actual withdrawals or partial surrenders from your policy's cash value. Since the money you pay in as premiums has already been taxed, should you take a withdrawal from your cash value, as long as the withdrawal doesn't exceed the total amount you've paid in, which is called the cost basis, there will be no tax on that money. Now, regarding the insurance company rules for using the cash value of your policy, you can leverage the cash value by means of policy loans, which do not come out of your cash value, but rather are funded by the general fund of the insurance company. And because they are loans and not income, there's no tax on those loans. Because your cash value is being used as collateral for the loans, many insurance companies will withhold paying dividend interest to the cash value that is being used for collateral. That's called direct recognition. Some insurance companies do not withhold paying dividend interest to the cash value being used for collateral, but continue to pay dividend interest to your entire amount of cash value, whether it's being used for collateral for loans or not. And that's called non-direct recognition. That's why it's best to have your whole life policy with a mutual company that has a non-direct recognition policy on loans. Now, here's the thing that makes infinite banking such a great wealth building tool. Assuming your policy was designed for maximum cash value growth and with the right company, in general, life insurance companies pay the highest compounding interest rates available anywhere. And the interest paid has a minimum guaranteed interest rate. Add to that the dividends that mutual companies pay to their participating policies, along with the compounding feature of the dividend interest paid, and you have the greatest guaranteed interest earning cash account going. So here's where the cash value of whole life becomes super valuable. You can leverage your cash value with policy loans at a lower simple interest rate than the compounding dividend interest your cash value is earning. So you're always growing your cash value even when you have it leveraged and are paying interest for the loans. Another beautiful aspect of the policy loans is that you determine when and how much you will pay on the loans. It's entirely up to you. Unlike any investment accounts, including 401ks, TSPs, IRAs, and managed investment accounts, the gains on whole life insurance cash values are guaranteed. There is no risk of loss. And you can take policy loans against your cash value and still earn that high compounding dividend interest on the money. Also, unlike any investment accounts, whole life insurance will pay a tax-free cash benefit to your beneficiaries when you die. That will be multiple times what you have paid into the policy in total. That's wealth that you will pass on to your beneficiaries. Now, for the reduced tax benefits. The more you can stuff into your cash value, the more and faster your cash value will grow. And that cash growth is tax-free. You don't even report it to the IRS when filing your taxes. Any other savings or investment accounts, you are required to report your gains and pay tax on. And you can use the money, including the gains, to finance things that you buy or to invest in other areas without paying any tax on your loans by simply leveraging your cash value with policy loans. When you do take policy loans, in many cases, you can deduct the loan interest from your income tax. Now imagine this scenario, especially if you're self-employed or a 1099 employee, or you're able to collect your paycheck without any tax withheld or minimal withholding, and you put as much of that income into your whole life cash value as possible, then when it's time to file and pay your annual income tax, you take a policy loan to pay the tax bill. In this scenario, you're actually paying your tax bill with OPM, other people's money, the insurance company's money. All your cash value continues to earn that high compounding dividend interest, and you get to deduct the interest on your policy loan from your income tax, which you are using to pay your tax bill. Holy crap, right? Instead of paying estimated quarterly income tax and getting nothing for it, you put your money into the cash value of your whole life policy and earn high compounding interest on it. Then when it's time to pay your income tax, you take a policy loan, which does not reduce the dividend interest you're earning, and you get a tax deduction for paying your tax this way because of the loan interest you're paying. So you build your wealth by earning high compounding dividend interest, which is tax-free. You can use that money as leverage to use OPM to finance things you buy or invest in other money-making ventures while it continues to grow with high compounding dividend interest. You can leverage your cash value to pay your income tax while your money continues to grow, and you get a tax deduction for the interest charged for your leverage loan that you're paying to use your tax bill. Is this great stuff? Or is it the greatest, most powerful finance strategy in history? Again, if you find this to be helpful, please like this video and subscribe to this channel. Also, please post your questions and comments here. You have questions, We have answers. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. The link is in the description box below. The link to buy my books on Amazon.com is also below. If you'd like to book a free phone consultation with me, the link to my Calendly page is also below. If you'd like to apply to become a client of ours, the link to the application is below. We're here to help, and we look forward to helping you. Aloha and mahalo for watching.